What are we doing? We ready to go? We ready to go? Welcome to the Closing Beat, everybody. Happy Wednesday. How's it going out there? It's going good. You know, we realized that we built this thing like 14 feet tall. Half the time you can't even see the darn thing. Do you guys even really care if this is just like some wall in my house? So think about that every day. Oh, welcome to the Closing Beat. We're financial advisors here. We like to talk about the stock market. What's going on, Liliana, Mark, Steven, Marcus, G, Chris Duran, Kevin Hawthorne in the house. Dabriga. I love it. Hey, congratulations, by the way. You guys survived, and the stock market survived, a special anniversary. It was 35 years ago today that the Dow fell more in one day than it's fallen this entire year. 22.6%. It's a number you probably never forget once you learn about that. Or where's my old timers? You guys been around? You guys lived through that? It was literally chaos for that day. It was a fun, interesting fact about the guy that actually stopped it from happening. But total chaos. And now it's just a little blip, little tick on the charts. You know, you zoom out far enough, it's like, oh, there it was right there. Doesn't look like a big deal. But man, falling 22.6% in one day, you think what's going on over here is a little bit wild. Imagine all of this in one single day. That was, in fact, 35 years ago. Maybe not the anniversary that we want to celebrate, but I've got some fun facts for you. You want to know something interesting about that? Since that day, if you said, oh, wow, that market looks kind of nasty here, I think I'll invest, you'd have had 10.71% annualized returns since that day. Now, let's make this a little more interesting. Who would have invested the next day? Like, who in their right mind would have said, this is the time I'm going to get in and I'm never going to, look back. I'm just going to let the money ride. That's not fair, right? So let's pretend that you were already in the market and you had to sit through a drop of 22.6% in one day. That would be literally, now I'm not messing around with this, it's not hyperbole, right? This would literally have been the worst possible timing ever in stock market history that you could have had if you had invested before that. What would your returns be going forward, assuming that you had the worst entry point ever in history? Worse than any other point. What would your returns be? 9.99% annualized returns, right? Now, that's, of course, 35 years of history there, but it goes to show that even if you have the worst possible entry, the returns still respectable, right? Still good returns there. So 10.71% if you invested just after the crash, 9.99 annualized returns if you invested before the crash, sat through it, wondered if your money was gone, and then worked your way through it, right? Very, very cool. I spent some time looking at that because I thought, that's the worst time. There's no other worse time that you could have invested in history. That's it, right? Wow, man. I mean, you could have invested at points where the market fell more, right? But my gosh, could you imagine, right? Just poof, one day, a quarter of your whole, investment's gone. Anyways, let's move on here. So here's the S&P on the screen for the day. By the way, there'll be no show tomorrow. We will be traveling to Georgia. If you want to come hang out with us, Friday night, 8 o'clock at the House of Louis inside the Chateau Elan. We'll be hanging out there. We're going to do our wine and wealth and everything from there. But you want to come by, buy a brother a drink, help your advisor out. The dude on YouTube's out here teaching you stuff. A little drink of something. You know what I mean? I won't order the lobster. It's fine. I'm just kidding. But if you're in the area somewhere up there and you do want to hang out, Friday at 8 o'clock, me and Eric, Cody, and Mama Jazz will be hanging out there. So there'll be no show tomorrow while we make our way up there. If you look at the S&P here, I talked about this yesterday being an interesting point. You want to participate, but you feel like there's more downside. Don't lie, right? You're out there. I feel the same way. I want to be in, but I'm like, I don't know. So is this now, right here, going to be a bear market rally, or is it genuinely a change in perception of how far the markets have fallen given the news that should be priced in? In other words, did the market fall too far given how, things are bad, but it's not 2008 bad, at least at the moment? Where do you stand? Right now, I'm leaning at this being a bear market rally. And the reason I say that is because, sure, we'll get a bounce. It'll be double digits when it does bounce. But ultimately, unless the Fed starts changing their mind, right, or slowing things down, why should the perception change? Because we know we can't beat the Fed, right? So you look at the stock market here and you go, okay, fine. We rallied a few days, pulling back. Maybe we pull back a little bit more, give us another rally. Earnings are good and all that. Take us into the rate decision that they have there. And unless we hear some kind of change, why shouldn't this just be a bear market rally? That's fine. I'll take it, right? I'm happy to do that. But still, just out of curiosity, where do you guys stand on that sort of thing? Bear market rally, or is this the tide changing? Remember, the tide changes before perception changes or before sentiment changes there. So something to certainly consider there. I do want to pop over here real quick to our notes from Jazz. I'm going to go back to, this is off topic here. Let me just see. I want to show you guys something. Yeah, here's all the other bear market rallies, right? So I shared this with clients here. Maybe I can zoom in. It's not going to look great, but here's the 2007, 2008 bear market, right? The rallies are double digits. So if we get a double-digit rally, can you imagine seeing that bounce of 24% right there and thinking you found the bottom, only to realize there was another 27% left to go, right? Now, that was a rough time there, but here's 2002. Right? I could probably just slide this over. Do you a favor there. There you go. So notice the rallies, double digits, right? Big time rallies. We get a 21% rally from here. You would, well, that'd be impressive, but you would think, ooh, there's the bottom. Darn it, I missed it. Only to have it turn around, drop 30%. 20% rally, drop 19%. So I pointed this out in our notes from Jazz, which, by the way, Charlie says we can make it happen where people can sign up for this. We don't charge for it. It's free for clients, but maybe see if you guys want to have a little bit of it too. Double-digit rally, right? Double-digit decline before the ultimate rally. So really interesting here how we expect a double-digit rally, but what is it? Is it a rally on hot air inside of a bear market? Or is it the rally that ultimately produces a higher low that then perception and sentiment changes that takes us higher? I don't know. I think it's a tough one. Now, today in the stock market, it's a little tough to read, if I'm perfectly honest. Most days you look at the market and you go, I kind of get why that happened. I understand why people, where they're at, what they're thinking, where perception is and all that. You get a feel for it just looking at it day by day. Today was a little bit tough to read because earnings. Right? It's kind of hard when Netflix is doing some heavy lifting here. Right? Trying to pull the markets up. In fact, if I look, Netflix was responsible for about almost 2 points on the S&P today. Just the weight of that. If the market would have been flat and no other stock was moving, we'd have been up 2 points. That's the impact that Netflix would have had. Look at ExxonMobil, same thing, about 1.5 points. There's a lot of interesting patterns over there in energy if you're curious or wanting to look around there. United Airlines also was earnings driven. Good earnings report for them. And then Travelers, right? So inside the Dow, Travelers was the biggest contributor to the Dow. So in other words, if the market was flat today, if the Dow was flat, it would have been up 50 points just because of Travelers. That's how strong that was on the day, right? Chevron would have been second, by the way. Chevron's that breakout we were talking about. So it breaks out today, 3.25% gain on the day. It would have been responsible for 35 points. You could look at it the other way too. You could say if the market were flat, or if the market were down, right, this would have supported the market by 35 points and Travelers 50 points. So you have 85 points on the Dow that would have been sliced off if those two stocks didn't move. So I'm just trying to highlight the weighted, in this case, price-weighted performance of stocks. Remember, in the Dow, the more expensive the stock price is, the more say it has, right? So obviously, Travelers being a couple $100 and Chevron almost being a couple $100, that's very helpful there. Okay, let's go back over to the charts here. So on the day, you got oil, a little bit of a higher low. This is what I'm talking about with the market. Do we get a rally like this that then pulls back and maybe hints at a higher low? That's kind of what I'm looking for here. That's kind of the idea that I have, because think about how much time would have to pass. We rally, if this is the stock market over here, we rally into and through the Fed meeting. Maybe they don't change their thoughts and what they're going to do. We start pulling back a little bit. We find out inflation numbers maybe are starting to come down, hopefully, a little bit faster than a fraction of a percent would be nice. And so then we start feeling that tide change a little bit. I just don't think that this is where the tide changes, because you can look around. right? Who thinks that this is great? Yeah, we're going to rally from here, and that's the end of it. Anyways, looking at oil, you got a little bit of a higher low here. Oil companies have been saying now that they're more confused than ever. You had Biden out today, Washington speak, saying, "Go ahead, drill. What are you guys doing? You're buying back your stock. You're paying dividends. We want you to drill." Well, that's a 180-degree difference than what's been coming out of Washington. They've been saying, don't drill. We want green energy, no oil. Let's just not even use it. So oil companies, like, on one hand, they're like, well, if you don't want us to drill, we're not going to spend money drilling. We'll just buy back our stock and give investors dividends. Okay, we have all this money. Now Biden comes out and says, go ahead and start drilling. And they're like, we can't just flip a switch. If you're familiar with the oil industry, they can't just start drilling and gas prices go down. There's lead times here, and we're not talking days. So very interesting there. I suspect and totally agree with this. I would do it too, even if you hate or love Biden. It's a midterm positioning thing, right? We got to get oil prices down. We know the consumer and the general voter, right, is concerned about gas prices. So he has to do those kind of things. Whether it turns into something, I don't know. But well played, sir, because got to do what you got to do to get your votes, right? At least they do. I don't have to do that. Anyway, so that's oil. Bond markets. Oh, man. Brutal decline in bond prices here yet again. Rates continuing to rise. That is a very consistent and thought is programmatic downtrend. That's what we talked about in our Wine and Wealth before. I think I mentioned it here as well. Here's the bad news. I started digging around, right? Financial advisor, I like looking at numbers. Here's where we got. The 30-year national average mortgage rate, 7.18%. Hallelujah, that's high, right? That's a big number. So let's pretend $400,000 house. You're a good person. You put down 20%. That's $80,000. So you go, I'm going to finance $320,000, and I'll go ahead and take the 7.18%. I don't need to go through payments and all that stuff. You get it. A couple $1,000s in mortgage payments there. Here's the fun part. People move on average in years 7 or 8. Right? That's the average time that we'll spend in a house as Americans. And it's leaning more towards 8 right now. We stay a tiny bit longer. It used to be 7. So let's pretend $400,000 house, you put 20% down, you're going to go ahead and pay the 7.18%. I don't know that anybody else would calculate it this way, but in the first 8 years, it actually costs you $175,000. It's actually like $173,970 something dollars, right? It costs you that. That's not how much you would pay back in principal and interest. That's just the interest. And by the way, that is with no origination fees, no lender fees, no points, nothing, no closing costs or anything. That's what it costs you. So yeah, housing market's going to slow down a little bit when somebody figures out it's $175,000 for me to live here for 8 years, the first 8 years of the mortgage. Oh, my goodness, those numbers, man. You got to think twice about that. Anyways, looking around at the sectors here today, let's take a look. Energy is going to be your leader. That's because of the rally in oil. That's got a very similar pattern to a lot of the top stocks by weight in the energy sector. So something to take a look at there. Now, this is the 5th day right here. So it's the 5th day since we marked that low. It's been 1 week, right? So if we look at the sectors and see who's leading off of this low, do you want to be with leaders or do you want to be with laggards? Most people would want to be with leaders. Because of today, energy is going to be the leader. Financials come in second place as the leader off of lows, about a 5% gain there. Communication services comes in third, which is interesting because that's a risk. That's a cyclical risk, interest rate sensitive, very aggressive type sector there. So find that kind of interesting there. You could probably guess why that is because of earnings there. Industrials come in 4th place. In last place, consumer discretionary, which is where you would expect it to be, given that we keep calling for a recession. However, we're going to define it, so that's where it is. Consumer staples, I wouldn't expect this to have been lagging as much, but consumer staples are lagging behind. That is because of input prices for consumer staples. So all else being equal, inflation not being high or anything, consumer staples is genuinely being held back by higher input prices, the cost to make the dog food, the cost to make the jelly and things like that inside of that space. So that's what's going on there. Like I said, Thursday's Wine and Wealth, we will be actually on location at the Chateau Elan. If you want to hang out with us on Friday, it'll be 8 o'clock at the House of Louis at the Chateau Elan is where we'll be. It sounds fancy, doesn't it? It sounds really fancy, but yeah, it's a cool little bar place to hang out there. And Cody, you ready? I have a poll for you guys, right? It occurs to me that I could just ask you guys. So trying to come up with what study we will do next. What would you like to see? A lot of times I just throw numbers at you. So here we go. We're going to put a poll up there. Which study would you prefer? I just thought of two things. Number one, the highest dividend, you can post it whenever you're ready. The highest dividend yielding stocks that are outperforming the market. Would you want to know a list of those, meaning they didn't fall as much as the market, but they have a high dividend yield? Maybe they have a total return for the year that's positive. Or number two, would you rather have the results of a study where we look at the most efficient, highest potential returning, highest premium paying options on stocks from now through the rest of the year? In other words, what are the best stocks for you to sell covered calls against where you will make the most, assuming you get called away or if the stock just expires worthless, for your efforts, right? For your time and putting all of that in there. So which one would you rather see? Highest dividend yielding paying stocks outperforming the market, or stocks with the highest covered call premiums relative to what it takes to put that trade on? In other words, using the least amount of capital to make the highest potential return. We'll take a look at that, see what you think. Stocks in the news, here we go. Netflix, this is that breakout. We talked about this yesterday when after hours it broke out outside of that range. So the bias is to the upside for the moment after being down 60% there because of having, really no growth in their subscribers there. They beat on that number. They took a jab at Disney and others, Roku and stuff, saying that they think that those companies lose about $10 billion to get growing. And the CEO said, meanwhile, we're making $5 to $6 billion. They're going to work on their ad-supported tier where you can watch ads, 30, 60-second ads. They said advertisers are already showing extreme demand for doing that, and they don't think there'll be a lot of people that will scale down to outside of the paid version into the still paid version, but with ads and a lesser price there. So yeah, we'll see what happens. So far, it was a good day for them. Next up, you got Starbucks. Starbucks, they own Seattle's Best. They're going to be selling that to Nestle, by the way. So that's the news for Starbucks. Didn't really move the needle too much. It's not a huge position for them. Travelers Insurance came out with earnings better than expected, revenues better than expected, less payouts. If you're an insurance company, the less you can pay out, of course, for claims is good. So good news for them. United Airlines, it should be coming up. There you go. That was higher today. Their total margins, they're expecting to now be above their 2019 levels. And remember, you can't see the thing, but remember that when we measure airlines, we measure current performance versus pre-COVID because they couldn't do a whole lot during COVID. So they said, okay, we think we're going to have our margins right back there. That's really, probably what moved the stock. Then you got Adobe in the news. Adobe reported, they kept their guidance for the next quarter, right? So they had fairly positive guidance. They are still below what Wall Street was expecting, but they kept that guidance going forward, and it did help the stock a little bit today. The focus on their earnings is going to be, they bought, not Figma. What did they just buy? Figma, right? Yeah, they bought Figma. So that, because of, think about what, I don't know if you're a Adobe user, but right now, you use Premiere, Photoshop, After Effects. You're a designer. This is probably your job, or you're a very advanced person that likes to use these products and you're not a designer. Well, the idea behind their recent purchase is now we can attract everybody who's not a designer and they can still collaborate. Right now, it's very difficult. It's coming and it's working little by little, but it's hard to collaborate inside of Premiere, better than it used to be, but it's hard to collaborate with somebody else. Inside of the new purchase there, they can collaborate easy. So the concept is we now have this sort of traditional software versus in-browser software. I can go in, I can do something, you can take a look and see what you want to do in there, and I think that's going to attract a whole different audience there, but it's going to take a while for that. And then their goal is, by the way, to slide everything else into that same sort of idea. So maybe one day you're able to use the Adobe After Effects software, but you can also just go right into a browser, use it there, someone else can pick up where you left off. Long way of saying that. Anyways, tomorrow, there's not much they're doing to stop this talking here, but 1, 2, 3, 4, 5 Fed members speaking tomorrow. You get the natural gas numbers. You got earnings from American Airlines, which now we're expecting to see, maybe they don't beat as much, but we're expecting to see something good from them given how United Airlines did. You got Nucor, Philip Morris, Freeport McMoran, Dow Chemicals, and Alaska Airlines as well will be reporting. So that being said, I will take your questions and we will see. Can I see the results of the thing? Oh, look at that. Yeah. Okay. So you guys prefer by a 3-to-1 margin to see the highest dividend yielding stocks that are outperforming. Can do. I love it. Oh, you should have voted. Those of you typing it in there. I'll take your questions now if you would have questions or would like to hang out for a little bit. Or you think you're going to buy some puts on China stocks. I saw they just decided not to share the GDP numbers. A couple others as well. Paul says 7% mortgage is cheap compared to 10 or 12%. I would agree with that. I think the trouble here, though, is how fast we went to 7%. We can all digest that at some point, but we can't digest a 7% interest rate when home prices fell by 2%, right? Or something meaningless, right? Home prices either need to come down or we got to get a lot of inventory out there, which will still bring down prices. But how fast that happened, crazy, right? Crazy. Thoughts on Alibaba? Time to buy or wait on Alibaba? You want to jump in the middle of those China stocks like that? You feeling violence today? So you got a downtrend here. There's no good reason to suggest that the fact that it made new lows today, just barely, means that today is the day that you want to buy it and expect it to reverse course and fight all that selling pressure to start moving higher again. So I can't tell you what to do, but I can tell you I wouldn't. I think I'm allowed to say that. I don't know. Snap's still dead money. It's been dead money for a while. There's nothing new to say there. Why? I can't volunteer a client's dollars to go into something that's dead. Maybe a little bit. It can be an insignificant portion of a portfolio, but you can't make a commitment in any way to this when it's showing you it's not willing to do anything. That's a tough one. What happened to Paul Pelosi lately? I've heard some of that, the most recent goings on there. Financial Wisdom. How you doing? That's a cool name. Do you think this is a bubble? What bubble? In what? I missed the previous question there. Sorry. Drum Corps auditions start next month, man. There goes my money. Yeah, I was working with them on something. I won't say what it is, but Steven, you know how it's kind of not impressive who always wins and gets first place or second place? It's kind of like whatever. But you know how it's really exciting when somebody who maybe wasn't going to make finals, like the Troopers, makes it to finals? I think there should be we should do some sort of award. I'm trying to work to, can I sponsor 12th place if they hadn't been in finals and just give them a big grant or something? I think that'd be super cool. Because then now they have a financial reason, the crowd be into it and all that stuff. Anyways, I'm not going to go crazy on that there. Maybe where you can't afford for it to go up. Shane, what are you talking about? Maybe buy where you can't afford for it to go up and sell where you can't afford to lose it. Yeah, we're just mixing words to convince yourself to buy a stock now, aren't you? Yeah, there's a way to jumble the words up as much as you like, huh? So we're at 75% want to see the high dividend yielding stocks that are outperforming, 25 on the highest covered call premiums. You got it. I will still do the highest covered call premiums. I will put it in the research site so that we don't, miss out on doing something. And plus, I might have already started this anyways and kind of thought you guys were going to choose something else. Uh, anyways, I'll wrap it up there. Remember, no show tomorrow. And if you're in the Georgia area, you want to hang out, that's cool. If not, that's fine with us. It'll be another day. We just thought we'd take the show on the road and see what happens there. And I don't know what's going to happen there, but if we see you there, we see you there. Otherwise, enjoy the rest of your week. We will still have our FinTips videos. I got a good one coming out tomorrow, and we will see y'all back next week. Thanks for watching, and genuinely, thank you for thinking about us here at Jazz Wealth and actually working with us instead of the big guys and the Raymond James and all those kind of people. We treat you better than that. All right, enjoy. We'll talk to you soon. See ya.